Let's stick with that commodity theme and just ponder the sizable moves we've seen in these markets since the closeout last week. Jonathan Barrett is from Commodity Broking Services and he's standing by in our Sydney CBD studio. Jonathan, what a beating these once white-hot commodities took in the session. What's been the trigger point? Is it all about China? Is it all about this tightening that's presumed to happen but hasn't yet happened?
Oh, Carson, look, it was a very, very interesting move. There's no doubt about it, because when you look down the sheet of commodities, everyone was pretty much negative, and some with some very sizable moves. I still think it's a combination of things. Obviously, I feel that there's obviously still concerns in Europe concerning debt. That saw people move to the US dollar. US dollar remains very well bid at the moment. But then on the other side of that, we're starting to hear stories, obviously, in China, that because of last week's data, because of what's happened, I think also at G20, that China in itself is looking to continue to slow her economy. And if she's continuing to slow her economy, then so will the demand for commodities. And as a result of that, there was a few snippets that came out that gave us an indication that we're looking for a realignment in some of these commodity prices.
Before we look at that second theme playing out, China G20, just let's go back to the dollar. You know, you said that's sort of well bid. And yet we knew in the last preceding weeks the build and short positions was sizable. How noticeable is the unwinding of that been, and how has that sort of evened itself out?
Look, the growth is certainly coming back in terms of the shorts. And I think that the market is slowly squeezing itself, but we still are predominantly short. We haven't broken some significant levels. We need to get through 79.20 on the dollar index. But our expectations are that we can see a squeeze, whether it's a squeeze or a new investment trend, I'm not quite sure. We'll have to see what pans out in Europe. But at the moment, I feel that the market wants to go towards the US dollar, perhaps as more safe haven. But that US dollar index, I think, can reach through to that US 80, maybe even up to US 82.
And let's then just ponder whether the data out of the US this week will trump the European headwinds that are building. In other words, if we do see an escalation in these problems the bond market says are occurring in Ireland, for instance, is that going to be enough to displace the data, the slew of data that's going to come out of the US?
Look, I think this is interesting because it's all inflation data. It's PPI, it's CPI, and some leading indicators. And I think what the market wants to look, they want to see that there is this sign of life in the economy. If they can see that the PPI increases, the CPI increases as well, then that'll start to reiterate Bernanke's policies in terms of sort of creating that little bit of inflation which he really wants. So if we do get a number that are just a little bit more upbeat, that's going to suggest that the US economy is certainly moving and that we're going to see more demand coming through. If we don't, then we go back to a dollar bid scenario.
And Jonathan, tell me about the Fed's moves, because looking at the numbers, the way the markets have finished their weekly trade, since November the 3 and the Fed dumping of $600 billion of fresh cash, we have given up all our gains so far this year on the Dow. What does that tell you?
Look, when I look at the Dow, you know, I see that a lot of investors have actually priced in stimulus packages, and their expectations towards solid returns going forward are firmly priced into the market. I would not be surprised to see quite a significant readjustment in the core values of return in some of the US equities, because you've got US equities, as we suggested, 2-year highs, but then you've got the Fed continuing to add an extra $75 billion. So he's got a concern. So we really need to see that occur. Otherwise, US equities, I think, can come under quite a bit of pressure.
Because the thing is, ultimately, this is only further debasing the US dollar. We know the Fed has this intractable problem on its hands, you know, growth faltering in the second and third quarters. It needs a boost, and one of those ways is to make money a whole lot easier. So that's the entry point for these commodities. When do you get the kind of exploitation of that theme?
Look, I think it has to be at good levels, and this is where the market will work itself out. Commodity prices have to find levels where they clear profitably. Now, they haven't been clearing profitably because we haven't had the right area or the right pickup in demand. So they should come under pressure, in my opinion. They should continue to come lower over the next month or so, find a base, and then I'm looking forward to Q1 end of quarter 1 for things start to pick up again.
The thing is, this seems to only be telling part of the story, because what was interesting last week was that investors also sold treasuries along with everything else. They didn't even go into that perceived safe haven class at all. Where did they go then?
Well, they just sit on the sidelines and they just wait. And this is one of the interesting things, because when you just go to cash, then the mobility of cash is so quick. So when there is an expectation of a change in trend, you see a lot of hot money move very quickly. And that expectation moves the markets to an imbalance, to where we find a balance from where the trend can commence.
Because the thing is, what is so different about now as in the past? Because I've just been looking at the historical data. In the past, we saw investors go back into safe haven treasuries whenever there were European flashpoints on debt, whenever there was Chinese growth concerns. It was the treasury market that they went to. They didn't do it this time.
I think it's, once again, they want to see a few more triggers occur. I think the commodity market has moved quite quickly, as we know. We want to see what actually is happening in Ireland. We want to see what's really happening in Portugal. Will Ireland default or will they not? If they do, that's going to raise the level of concern. Yes, then they'll move into treasuries, they'll move into that safe haven. That will further enforce the trend for the US dollar to go higher and commodities to go lower. So when you look at the whole thing, wait for those triggers, but that hot money has decided to move now, particularly on the commodities and the US dollar.
How do you briefly, finally, Jonathan, make hay in this market? You know, do you sort of take the conventional route and go into cash and be like everyone else, or what's the smartest contrarian play? Because at this point, you might argue there are some attractive entry points with prices where they are.
Well, at these levels, what we're doing is we're putting a few hedge on our equities, because we feel there's a little bit of concerns there, but actually going short some of those commodities which we do think are overpriced. You know, I still think that oil's at the top end. I know I'm a bit of contrarian to what a lot of other people feel there. You know, when you look at your grain markets, the grain markets are still very high and should come back to good value. So I actually feel going short or buying contra ETFs in a lot of the commodities is probably where I place some of my cash.
And do you feel almost sometimes caught between a rock and a hard place? Let's take sugar. The big sell-off that occurred there, and you look at some of the commentary saying, look, the trading houses were the main selling force. They were between this rock and a hard place. They were long sugar, but they didn't actually physically want the sweet stuff.
Well, that's exactly right. Well, that adds to that volatility. A 13% move overnight is phenomenal. When you just look at the sheer size and the volatility of some of the moves, yeah, sure, you've got a lot of participants there, which create the volatility, also create the liquidity. The trading houses go long, they'll just as soon as go short when they need to, and that'll further exaggerate the move in the commodity, but they'll exaggerate it so that provides opportunities for us that see where the real value is.
I was going to say, where to supply and demand, it seems it's all about trading for trading's sake. Jonathan, have a great week.
Thanks, Carson.
We'll talk soon. Jonathan Barrett there from Commodity Broking Services.